You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, we're a week back from huddling up with myself and Mark Longo, answering some of the listener questions. Let's get right back into the swing of things, and let's look at a diagonal call spread this week in a very popular stock, at least recently. They've been in the headlines quite a bit. Little-known company called Boeing. Symbol is BA. Boeing has been beat up, and then it ran up, and now it's getting beat up again. But one thing that's kind of interesting in Boeing is that it's going to be announcing earnings. So we got a couple of good things about Boeing as far as option trading is concerned. We have a $366 stock. As a matter of fact, we're taping Options Playbook Radio as of 4:10. It is a Wednesday. The markets are closed, and Boeing last traded at 365.97, down 307. We're going to round that up to 366. And they're announcing earnings on the 24th of April, so just a few weeks out. And they'll be announcing earnings at that date and time. So we got some increase in implied volatility because the last few days Boeing has dropped, I'm going to guess, around 15 to 20 points. And that creates premium, which makes the ability to trade options interesting in that when you have a high price stock and you have high implied volatility, those are the makings of a nice mix as far as option premiums are concerned, and lets you get creative with some of your option strategies. So because of this and because of the potential earnings, we're going to look at a diagonal call spread. And what we're going to really do, a diagonal spread just means that we're going to be buying a longer term expiration than we're selling. This is really just a derivative of a long call spread, where I buy a more expensive option contract, the closer to the money call, and then I sell a less expensive option contract, which goes a little bit further away from where the current market is at or further out of the money. That is just a simple long call spread. Now, if you do it in the same expiration, that's just going to be called a long call spread, a debit spread, a bull call spread. Your risk is the net debit that you pay for the trade, et cetera, et cetera. What we're going to do is we're going to buy that same option contract. In other words, it's going to have a lower strike price than the one that we're selling. But when we sell the next option, we're going to sell it shorter term, but once again, farther out in strike. And the reason why we're going to be doing this is we're going to do something around the earnings date. First of all, whenever we're looking at an earnings date, we want to make sure that the marketplace thinks the earnings date is happening the same time that the information does. So, for example, they're saying the earnings date is on the 24th. So if we look at the April 18th expiration, which is 8 days away, and we look at the at-the-money implied volatility, it's showing 28% implied volatility. And then we go out to the April 26th expiration, obviously 2 days after the earnings report. That's when that expiration would occur. And we see that that's trading for a 38% implied volatility. So it's definitely showing a skew or a tilt, however you want to call it, implying that, yeah, there's something that's going to happen between these two expiration dates. Makes you feel pretty confident that that earnings report is a real earnings report or a valid date, if you will. So with that being said, let's see what the expected move is. If we look at the April 26th expiration, the 16 days away expiration, and we look at the most at the money straddle, the underlying right now is trading at 366. As I said, we're going to round up a little bit. So the 365 call and put is now trading at about $24, once again rounding off. So the expected move over that time period is about $24. That's including the earnings report. So we're going to be cognizant of that. We want to buy some options that could get in the money over after that earnings report is done. So if I were to just look at buying options outright, the marketplace is expecting a move around $24. Now, the best way to explain expected move in my world is to think about it as an over-under on some type of sporting event. The marketplace is saying this is what the expected point total will be for this sporting event. Do you think it will be under or do you think it will be over? But this is the marketplace expectation of the total score for that sporting event. Well, in this instance, the way that long straddles are kind of viewed, they call it expected move, but basically it's the marketplace expectation. Do you think it will go more than what the marketplace is expecting, or do you think it will go less? Well, when we're buying options, we want to make sure that we're within that range. So if the marketplace thinks it can go 24 points, well, we don't want to go out 40 points and buy an option contract because it's cheaper. Well, the marketplace doesn't even think that that can happen. So in general, the marketplace doesn't always get it right, but you got to take what the market gives you when you're setting up your option strategies. So we're going to go about 10 points out. We're going to look at the 16-day option contract. That's going to be a fairly expensive option contract, and that's part of the reason why we're going to get creative with our strategy. We see the 377.50, right? About 11.5 points out of the money. 377.50 strike call option with the April 26 expiration. That bid ask with the market closed on Wednesday, April 10th. The bid ask is 655 by 7. So the bid ask spread is going to be a little bit wide because the market's closed. But with that said, it's not ridiculous. It's about a 45-cent wide bid ask spread. And in this instance, if we were to buy that option outright, we would pay, let's just look at the ask, it would be $7 or $700 for one option contract plus commission, and that would be our maximum risk, but we would have unlimited upside. Now, if we did that, that's a solid, it's right in the middle of the expected move. So the marketplace does think that it can get there and it could go beyond, which is a good thing. You want it to go in the money if you can, if you're buying out of the money option contract. But to me, you're really paying up for this underlying. So we'd like to ride this in the earnings or at least have that option. So what we're going to do is we're going to go shorter term and we're going to sell an option contract that's going to have a very large rate of decay. Now, these option contracts have some increased implied volatility overall because the market's been down so much. So because of that, we're going to take advantage and sell some premium. We're going to go to the 380 strike call, because we're kind of worried about a dead cat bounce here before earnings and the market starts coming back. And we're going to sell an option contract that's a little bit further out of the money, but it still has a decent implied volatility. It's trading at a 28% implied, where we're buying a 38% implied. With that said, it's still $1.26 on the bid and $1.38 on the ask. So we're looking at the April 18th expiration, 380 strike call. Now, part of the reason why I like to do this and sell a little bit further out of the money is the delta on that option contract is about 28, where the delta on the one that we are buying, the 377.50 strike call, is 38. Okay, so if the market starts coming back and we also have volatility on our side and volatility starts to increase on the option that expires after the earnings, and it slowly decreases on the option that expires before the earnings, we have set up a creative trade that's trying to take advantage of the current market conditions. So if the market starts going up in this scenario, well, that's okay. We're net 10 deltas on this position. We're net 10 deltas if we bought one and sold one. That means that that should increase in price. We just want to set an alert and make sure this market doesn't go beyond our short strike, our short option contract that's in the near-term expiration, which is the 380 strike. We just can't let it go past that. But if it does, if it goes up to the 380 price, we should be profitable before that first expiration. Now, here's the ideal scenario. We sell that option contract. It's 8 days away. The market kind of hangs where it's at 366, maybe drifts a little bit up towards that 380 level. That would even be better. The 380 strike call option goes away, and we end up long our 377.50 strike call, and we can decide if we want to be long that call going into earnings or if we want to just get out of that trade. But bottom line is, we're paying a lot for this option contract because we're riding it into a volatile stock at this point in time, into an earnings. And because of that, we're trying to reduce the overall cost. So, summarize. We're looking at doing a diagonal spread in calls on Boeing. We're going to be buying the expiration that contains the earning report. The expiration that expires after the earnings are announced. That would be the April 26th expiration. It's 16 days away. We're going to buy a strike that's within the expected move, but it is still out of the money. With a stock at 366, we're going to be buying the 377.50 strike call. We are then going to be selling a nearer term option, the April 18th expiration, which has 8 days away from expiration. We're going to go up a little bit in strike, a little bit further out of the money on the one that we're selling, just to try to get us a better delta scenario. And we're going to sell the 380 strike call that is trading 126 by 138. And that has that April 18th expiration, only 8 days away. So net, the midpoint of this trade is $5.46. Our expectations on volatility is that the back month option contract may increase in implied. The front month either stays the same or basically it decays because we have such a short time frame, only 8 days. We're going to be very cognizant of it going beyond 380 before that first expiration date. But if it expires worthless, that allows us to get into an expensive option contract at a lower price. Our net cost at the midpoint would be $5.46 for a 1-by-1 diagonal spread. That would be $546 plus commission. That's our total risk all the way up to that first expiration date. If we do that, the net debit paid on all diagonals. In this scenario, where we're selling the option contract with a higher strike than we are buying on the call side, that means the maximum loss here is the net that we can pay for it. And we can decide how it plays out as that earnings report approaches. Well, that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish into money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.